Stop looking at the noise. Forget the FUD. Right now, on the Hedera chart, a hidden message is screaming, buy. I'm talking about a textbook bullish divergence forming right as a massive, regulated financial force unleashes $100 million into the ecosystem. This isn't just retail chatter. This is the TradFi world putting its money where its mouth is, under the strict oversight of the Abu Dhabi Global Market. We have a technical breakout brewing and institutional adoption hitting peak hyperdrive simultaneously. This combination is a launch code for HBAR, but you need to understand the precise price targets and, more importantly, why this regulated fund changes everything. Let's dive in. Welcome back to the channel, my crypto warriors. If you are holding HBAR or even just watching this distributed ledger technology titan, you know exactly how critical this moment is. Show your appreciation for the alpha by tapping that like button, and if you haven't already, subscribe and join the squad. We decode the market so you don't get wrecked. This is the big news. Hedera just secured a massive regulated boost. Hashgraph Ventures confirmed the first close of their planned $100 million Hashgraph Venture Fund I, all under the watchful regulated eye of the Abu Dhabi Global Market. This isn't some fly-by-night operation. This is institutional, regulatory-compliant capital directed squarely at early-stage Web3 and deep tech firms building on Hedera. My take is simple. The fund's license from the Abu Dhabi Global Market Financial Services Regulatory Authority is the golden stamp of approval. Institutions don't want speculation, they want durable financial infrastructure. When Kamal Yousefi, co-founder of Hashgraph Ventures, calls this a defining moment, he's not kidding. They are funding real-world services, the kind of enterprise-grade use cases that Hedera, with its Hashgraph consensus and Fortune 500-backed governing council, was built for. This shift from speculation to securitized utility is the ultimate long-term catalyst. Now let's talk about the chart, because the price action is trying to scare everyone out of their positions. HBAR has been in a grinding downtrend since that late September high near 20 cents, shedding around 30 to 35%. Ouch. That drop is brutal. Look closely. The price is forming lower lows, right? It's textbook bearish market structure. But here's the tension. The market is setting a trap. While the price action looks ugly and continues to test weak support, the Relative Strength Index, or RSI, is telling a completely different story. The RSI, which measures momentum, is actually printing a higher low around $0.1365. This is the classic bullish divergence pattern. It means that selling pressure is exhausted even though the price is still dipping. It's like a boxer throwing weak punches that just don't land. The momentum is gone, and the reversal is coiled and ready. I am watching this like a hawk because, honestly, divergence alone is not enough. We need the price action to confirm it. The immediate psychological and technical hurdle is the 15-cent resistance level, which was the November high. We also have a descending black trend line acting as dynamic resistance since September. A decisive daily close above both of these, especially with a volume spike, will invalidate the downtrend structure. That 15-cent break is your buy signal. If this bullish divergence resolves upward, fueled by the institutional money flow we're about to discuss, we are testing the next major resistance cluster at 18 to 20 cents within the next 1 to 2 weeks. The momentum shift will be violent and fast. The institutional adoption data is already confirming the macro shift. Real Allen Crypto highlights the Canary HBAR spot ETF surging its holdings to 465 million HBAR tokens, valued at $64.7 million. That ETF saw a massive $762,250 inflow on December 9th alone. This is institutional money buying spot HBAR and locking it up. The supply shock is real. But wait, there's more. Mark Chadwick screams about the USDC supply on Hedera surging to $125 million. That's a 62% jump in a single week. So, stablecoin flows are really the lifeblood of any high-utility network. This monstrous increase, over $30 million in new issuance in just 24 hours, shows that institutional banking and treasury activity is booming on Hedera, not just speculative trading. This means, Hedera is actually being used as high-speed, low-cost settlement infrastructure. And here's the key insight. Utility drives the price, and regulated capital absolutely loves utility. Skeptics love to shout about developer numbers, but, a Da Vinci graph really puts that FUD to rest. Hedera actually ranks third among Layer 1 networks with, 100 core developers. They are behind Ethereum and Cardano, but let's be honest, Hedera's focus is on enterprise-grade, high-quality, scalable solutions, not just a massive ecosystem of meme coins. The flywheel is turning. The $100 million fund is bringing in high-quality, vetted Web3 startups, Those startups go on to hire developers. The developers then build real-world applications like RWA, payments, and enterprise tools. Those applications generate massive transaction per second usage, which, in turn, burns HBAR for network fees. The utility here creates demand, and the regulated ETFs create an easily accessible institutional on-ramp. This, honestly, is the sustainable path to long-term valuation, not just market cycle hype. Look, the bearish divergence is flashing green, the regulated $100 million capital is flowing, and the network metrics, ETF inflows, USDC supply, are exploding. This is not the time to be conservative, this is the time to be surgical. Your battle plan is simple. Watch the 15-cent resistance. A break there confirms the shift from short-term bearish structure to a new, institutionally driven uptrend. Failure to hold the 12-cent area, however, extends the correction to that deep support at 8 cents, but the fundamental bullish signals make that scenario much less likely now. The market is rewarding utility. Hedera is delivering it. Get positioned. If you want to see exactly how this bullish divergence plays out, make sure you're subscribed. Disclaimer: I am not a financial advisor. This is not financial advice. I am a cryptocurrency analyst providing my professional analysis. The market is high risk. Only invest what you can afford to lose. Always perform your own research.